So investors have had a lot to think about in the last few years in relation to investing generally. Higher inflation, higher interest rates, cost of living putting pressure on the consumer. Not an ideal environment to invest in equities, let alone small caps. But a lot of things have changed in the recent history that have become more accommodating to investing in risk assets. Things like inflation falling, interest rates peaking, business conditions stabilising globally, as have economic indicators. They are improving. And we've got a solid employment market. Typically, small caps will outperform as rates fall, but they also outperform when rates are stable, so less volatility. So from our perspective, it's a perfect time to consider investing in small caps. As interest rates start falling, the desire for returns increases. Now, as I've described earlier, we think now's the time to consider investing into equities, and particularly small caps, because that's where the returns will be generated. Coupled with that, the fact that small caps have underperformed for the last 2 years against large caps in particular, and when you also consider the growth characteristics of the asset class, which is far superior than mid caps and large caps, that's kind of the recipe for a re-rating to the sector, particularly in a stable interest rate environment. Importantly though, to exploit the opportunity, you need a fund that's dedicated to the sector. You also need diversification. At Flinders, we invest in all sectors. We consider all industries for the opportunity to generate returns. But we don't invest in concepts. So the companies that we own are either profitable now or close to being profitable. In addition, small caps allows an opportunity to invest in industries that you otherwise wouldn't get exposure to or could access if you think about all Australian equity portfolios or large cap portfolios. So a case in point is AUB Group. It started its life as an insurance broker here in Australia and New Zealand, but since that time has added underwriting capability together with a wholesale insurance business. This company is vertically integrated, which is particularly important for growth because it allows the opportunity to cross-sell. In addition, they are growing organically by taking share, and they are also growing inorganically through acquisition, which is powerful in this sector because consolidation allows you to leverage off your shared services and therefore your fixed cost base. We estimate this company will generate 20% earnings growth over the next 3 years. And what we learned through COVID is this company has defensive earnings. The last thing a business relinquishes is its insurance. In addition to that, the valuation is at a discount to its large cap peers, Steadfast, and it's also cheaper than a recently acquired business, PSC Group, which incidentally we used to own in the fund. So we have a business growing at 20% per annum that's attractively valued amongst its peer group, and from our perspective, it's a core part of our portfolio. This is a typical example of a stock that we would look to invest in the fund. Strongly growing business that's attractively valued. Ultimately, we need upside when we look to invest in these businesses. When you consider the overall Flinders portfolio, the overall characteristics are superior growth characteristics in the market and trading at a discount to the market. So we feel in an environment where small caps re-rate, we are best placed to deliver strong returns.